In the realm of financial regulation, anti-money laundering, or AML laws, play a pivotal role in mandating enhanced due diligence practices. These laws are designed to prevent the integration of illicit funds into the legitimate financial system. Your company must take proactive measures to know its customers and clients and the nature of their business, especially when the financial risks are potentially high. The cornerstone of AML laws in the United States is the Bank Secrecy Act, or BSA, of 1970. The BSA requires financial institutions and other businesses to assist government agencies in detecting and preventing money laundering. Under the BSA, organizations are required to keep certain records and report both large cash transactions and suspicious activity possibly signifying money laundering, tax evasion, or other criminal activities. Enhanced due diligence comes into play as part of a required know your customer process, especially for those customers who are classified as presenting a higher risk, such as politically exposed persons, otherwise known as PEPs, or companies with complex ownership structures. Internationally, the Financial Action Task Force, or FATF, recommendations are recognized as the global anti-money laundering and counter-terrorist financing, or CTF, standard. They advocate for due diligence procedures proportionate to the risks a customer or transaction poses. Enhanced due diligence is an expectation for high-risk scenarios and includes more intensive measures to identify and verify the client's identity, understand the business relationship, and scrutinize a transaction's purpose. The Patriot Act was enacted to strengthen U.S. measures to combat terrorism. It includes specific provisions to prevent, detect, and prosecute international money laundering and terrorist financing. This legislation enhances the BSA by requiring financial institutions to adopt effective AML programs and conduct due diligence on foreign correspondent accounts. This includes enhanced scrutiny of accounts involving foreign individuals, financial institutions, and jurisdictions that are considered primary money laundering concerns. AML laws typically impose strict penalties for noncompliance. This compels businesses to perform EDD when required and design comprehensive, robust AML programs. The legal frameworks necessitate that businesses establish internal policies, procedures, and controls to identify and reduce risks associated with money laundering and terrorist financing. In the digital age, cryptocurrencies and electronic money have also been included under AML regulations in many jurisdictions. Regulatory bodies are increasingly focusing on the transparency of fund transfers, mandating virtual asset service providers to enforce EDD measures as well. Your business must remain vigilant in its compliance efforts, adapting its AML strategies to keep pace with regulatory changes and evolving money laundering tactics. Enhanced due diligence requires continual assessment and adjustment to align with the shifting landscape of AML laws and the sophistication of potential financial crimes.